Okay, we're getting organized here. I just came from Jim Rogers' luncheon, so it went over, The Wisdom of Jim Rogers. That would be a good book. He's a fascinating guy. You had to choose between Jim Rogers and Steve Forbes, so who would you choose? Good question, huh? It's kind of like... Have you ever heard the story of Burdinen's ass? Anybody heard of Burdinen's ass? Harry has. Because Murray Rothbard used to talk about it in his book, Man, Economy, and State. So, Burdinen's ass is this ass owned by Burdinen, and he's standing behind two haylofts. And he's trying to decide which one to go over to. And both of them are so appealing to each other that he can't make up his mind. He's tending toward one, and he says, no, I think I'll go to the other. That one looks bigger, more appetizing. And he can never make up his mind, so he ends up starving. And, of course, this has been used over the years as the case for indifference curves. But, anyway, that's a whole area of econometrics that is probably beyond this audience, but one that I find pretty interesting. Now we move on to something that is perhaps even more challenging than indifference curves. It's Austrian economics. And I was on C-SPAN. They interviewed me this morning, and the very first question that Peter Slem asked me was, what is Austrian economics? But we're going to go beyond that a little bit. And we're going to ask the very first question to Christopher down at the end, or whoever has their cell phone on. Did you want to answer that first before we start?
I'm so sorry, Mark.
Okay. So what is Austrian economics to you? How do you... Give us just one example how you might use Austrian economics to make investment decisions. This is a new panel. I don't think we've ever done a panel at FreedomFest on Austrian economics for investors. So we will start with Chris and give us your perspective on that. But before you do, maybe you should just tell us a little bit about yourself.
Sure. My name is Chris Casey with WindRock Wealth Management. We're an investment advisory firm that bases our investment decisions on Austrian economic theory. So obviously the question is very relevant. And I'll give you two examples of how we use Austrian economic theory. And by the way, I think it's a tremendous competitive advantage for any investment advisory firm that uses it relative to firms that don't, because the traditional portfolio that anyone has, stocks and bonds, the two greatest threats to that portfolio will be inflation and recessions. And Austrian economic theory alone, I think, has an accurate description about the causes and the repercussions of both of those economic phenomena that could have devastating effects upon anyone's portfolio. So we definitely use it in our determination of what we anticipate the price level to be, as well as where we view the economy for the U.S. and worldwide.
All right, so Harry Verizor, you are a professor of economics at University of Detroit Mercy. You are chairman of the department.
Retired.
Pardon?
I was director of graduate studies, now semi-retired.
Yes, semi-retired, but still an investor.
Yes. And
you use Austrian economics for making investment decisions. And from what I've heard, you use a particular version of Austrian economics to determine the tops of markets. Can you talk a little bit about if that's the example you would like to use?
Yes. I've always been interested in the trade cycle since I was a young boy. And actually, my book that I wrote, I have a large section on the trade cycle. It didn't have to be this way, available from ISI Books.
Now, I think it's available here also, right?
I think it's available here.
Are you doing a book signing?
I would be glad to do it, yes. So I don't. I'll have to ask them. I just arrived. So.
Well, it didn't have to be this way,
Right.
you know.
It didn't have to be this way, right? But anyway, I became familiar through actually a practical banker. Back in 1978, I was having lunch at the Detroit Athletic Club with probably the most honest politician in Michigan, Senator Huber, who served on the bank board of Michigan National Bank. And he said, Harry, there's going to be a very, very severe depression. And I said, well, Bob, how do you know that? He said, because short-term interest rates are above long-term interest rates, and Bud Stoddard said whenever that happens, there's a depression. And, of course, there was. I mean, 1978 to 82 was a very severe time. In fact, in a lot of ways, that recession was worse. So I began a study of the yield curve. That's what it's called, the yield curve, and found out and started teaching it as part of my course in trade cycle theory. And I had students do their theses on it. I had one, Greg Keza did his thesis and went back to 1862 and saw that every time the yield curve inverted, sure enough, there was a recession. It has a 92% prediction rate. And the Fed actually, now we were doing this in the early 90s, the Fed finally published something on it. And they also agreed with our conclusion that it's 92% accurate. There are times it has inverted and there was no recession. But with every recession, sure enough, starting with, and my researchers, with the Great Depression, in March of 1929, the yield curve inverted, and sure enough, 3 quarters later, the stock market collapsed. And I've watched it, and I've used it in my own investments to great advantage. And I think it is the one indicator that Austrians can use to determine the tops of markets in their investment decisions.
Very good. Excellent. That's a real practical advice. And, of course, is the yield curve right now positive or negative?
It's negative in China. It's
oh, really? That's
yes.
interesting.
So, I mean, it became very severely negative. I think the short-term rates in some of the cities were up as high as 25. It was 25%.
Wow.
So the yield curve was steeply inverted, so which, if this happens, would portend a very, very severe problem in the Chinese economy. In our economy, it's very positive. Short-term interest rates are along 0.5%.
Even getting more positive, as a matter of fact.
Much more positive.
Yeah.
So it probably portends some long-term, at least for a while, rise in stocks and values.
Yeah. Now, Steve Mozzie, you are also a money manager, right? That you use Austrian economics. Give us an example of how you use Austrian economics.
Well, the way I do it...
Speak into the microphone there.
I focus on income. I run a concentrated portfolio. The issues, I think I probably I don't really time markets. I think I take much more of a holistic approach with Austrian economics and what it's taught. Obviously, Austrian business cycle theory, keeping track of money flows, interest rates. I was fortunate enough to be on CNBC on, I believe it was March 7th, 2009, which, remember, that was just about the very
Pretty
bottom.
Much the bottom.
Very bottom. And I couldn't look any more brilliant. Larry Kudlow asked me, well, where do you think the market's going? Well, it's probably going to be about 2,000 points high. I was just 2,000 points higher on the Dow. He asked me 3 stocks. I had 3 stocks already in my portfolio that I felt might be worthwhile. And, well, how do you know this? Well, what the Austrians teach you, with the business cycle, how the Federal Reserve steps in and starts manipulating and starts the cycle all over again. We were at a point where interest rates were falling, where the money supply was starting to get pumped up big time. It was going to be inevitable.
But, Steve, they were doing that 2 or 3 months earlier. Why did you think March of 2009? That sounds like a brilliant move if you were able to predict that.
Yeah, it was luck. I mean,
okay.
Yeah, it wasn't. I mean, I just got lucky. Yeah. That's what I'm saying. It made me
a good, honest admission.
Right. I mean, if they would have asked me 3 months early, I would have given the same answer.
Yeah.
So, and I would have been off. But
so there's no actual. I mean, Harry talked about the inverted yield curve as a way to predict the tops of markets. Mm-hmm. is there any strategy to pick the bottoms other than just a gut sense that it's gone as low as it can go? Or is there, a technical indicator you can use?
There is, and not the one that I use. I mean, I could ascribe it to Austrian economics. I could subscribe it to Graham and Dodd. It's a mixture. It's just the thinking process that the ability of Austrian economics to get you to think logically. The obvious thing is when it comes to demand. People talk demand driving the economy. Demand does not drive the economy, and all Austrians know that. When it comes to, I mean, I worry more about the sun going black than I do about demand. If somebody's not consuming, if demand's not there, it's because somebody's not producing and giving supply, and you know that's the problem. So it's just being able to think logically. I think that's more than anything that Austrian economics brings to the table.
Now, Adrian Day is our next panelist, and Adrian is a asset money manager and has been doing so for at least 15 years. How long?
1991.
Since 1991, so I can't count, but I figure that's more than 15 years.
50.
Maybe something like 22 years. And you have an impeccable track record. You have, I think, can pretty much beat the market over that time period, correct?
Oh, yeah.
And so tell us, do you use Austrian economics or you use something else to have this beat the market strategy?
No, that's a good question. And, I agree with everything that people have been saying so far. I particularly liked what the last person said about Austrian helps you to think logically about things. I think that's a very important key. It helps you avoid, obvious fallacies in the way of looking at markets. One of a specific thing I think that Austrian helps you do, and this has been mentioned, is look at the business cycle. Because the Austrian theory of a business cycle is really, the only valid, it is valid, and it's the only valid theory of a business cycle. And looking at the credit cycle and inflation, and, when we look about inflation, that doesn't, when we see the government increasing credit, that doesn't necessarily mean that we're going to get an increase in the CPI for a lot of various reasons, but including according to Austrian theory, and I hate to call it theory since it's correct. Theory implies something may or may not be correct, but we'll call it theory for now, right, Mark?
Well, yeah. I think we would say we'll test the theory empirically and see if it works. And we found that it works.
And we found that it works. But the point is, an increase in the credit cycle doesn't mean an increase in the CPI. An increase in credit doesn't mean an increase in the CPI. But it does mean that money is going to flow somewhere. So, what Austrian helps you figure out is, if we get an increase in the money supply, we're going to get an increase in the prices of certain assets. Whether it's going to be commodities, whether it's going to be, stocks, that's not necessarily so clear just based on Austrian theory, but it's going to go somewhere. I think Austrian helps you with the big picture, the broad picture. It certainly helps you, as has been mentioned, it helps you identify major tops and major bottoms. It doesn't really do very much with precise timing, in my view.
Yeah,
Some people
may disagree. It's not a technical system.
And it certainly doesn't help you, in my view, with precise stock picking. It doesn't tell me whether Newmont is a better buy than Barrick. But it does help you identify tops and bottoms, and that obviously is invaluable. It gives, as was mentioned, it gives you an edge up on a lot of other money managers.
So, Ty Andros, tell us about your services and how you use Austrian economics. Do you try to pick the tops and bottoms of the market, or you just say everything's going to hell and whatever that means?
Well, this conference is very interesting in that a lot of people can talk about the doom and gloom, but they really don't give you any solutions. And Austrian economics is actually the road to solutions and salvation. Austrian economics is very predictive. There were very few Austrians that got blindsided in 2008. It's human behavior, which really hasn't been mentioned yet. It is real things. It is real money. It is, people making rational choices to insulate themselves. It is a means of unmasking illusions that you may be operating under in your investments. It's many things. But most of all, if you can apply it in what you're doing in your life, you will be infinitely better than someone that's not. And you are at the juncture right now that you are going to be challenged like you can't believe, because we are at the end of a credit cycle that is unavoidably going to collapse. And as Ponzi money and Ponzi credit collapse, financial systems die in waves of insolvency. And that's when, you'll see Bernanke and everybody step up, but they're not really putting money into the system. They're putting debt into the system. And you have to understand that the bottom line of where we're at in Austrian theory is insolvency. And it is insolvency at every level of society. And it is, going to take us to places that you can't imagine. I've actually been coming to FreedomFest since 2008. And I give out my presentations. And I actually talked about the amount of money they're going to have to print. Harry's right about yield curves, but that assumes that we have a free market in yields, but money is not priced correctly. It is absolutely mispriced. In fact, when you go to zero bound, it is actually the sign of a dead financial system. And the only way they can keep the financial system running is by shoving blood in it with a pump. And that'll work for a while. People talk about deflation and inflation. Well, the bottom line of when inflation arrives, and it will arrive very quickly, I don't know if it's going to be this year or next year, but when it hits, it'll be like this. And it's when people wake up. And they wake up to the belief that inflation is the policy of government. And so we're really in a period that is going to be very challenging. We have 60% of I believe 60% of the American population is functionally brain dead. And they have not been taught...
Does that include the Freedom Fest attendees?
No, they're here seeking the answers. And, they actually, I think, went to school and learned the blocking and tackling of the Constitution and sound money. The type of monetary system we have was prevented. Okay.
I wanted to say a little bit about how I've used Austrian economics in my services. Now, I don't manage money, even though I'm the only one here who's totally lost his hair up here, because normally when you manage money, it's really a tough business. Do you all agree with that? For those of you who manage money, it is really tough. People really depend on you. They do not want to lose money, and you're promising them great returns. So anyway, I write an investment newsletter. I manage my own funds. So I use a lot of the principles of Austrian economics. And so I did a study, and I've compiled it in this book called A Viennese Waltz Down Wall Street. It's a play on Burt Mackiel's famous book, Random Walk Down Wall Street. And anybody who's read Human Action knows that human behavior in the financial markets, in business, in your personal life, is always purposeful human action. So it cannot be random. Random is something that exists in the physical world, but perhaps unless you're insane, it doesn't exist. The question of irrationality is a real question mark in my mind. So what I did was, in each chapter, I start chapter 1, I have a chapter on each of the major Austrian economists and what their contribution was, and then how do you apply it to the financial world. So the first chapter is on Karl Menger, the founder of the Austrian school, about that values are subjective and not objective. and there's dangers in a cost of production approach to investing. My second chapter is on Eugen Böhm-Bawerk and the importance of saving and capital investment. The Austrian school focuses on that better than the other schools. Then I talk about Ludwig von Mises and human action, and along with Hayek, the theory of the business cycle. I talk about Schumpeter and the concept of creative destruction and entrepreneurship. I talk about Kerzner and the discovery process, Murray Rothbard and the hard money movement. And then I even have a chapter contrasting the Chicago school, the Monitor school, and the Austrian school, which I think is very important. So anyway, if you're interested in this book, as well as Harry's book, and Adrian, is your book also here on international investing?
On resources.
Oh, on what's it called?
Investing in resources.
Investing in Resources, an excellent book. I highly recommend all of these that you get copies. And I'm having a breakfast tomorrow morning speaking about my book, Viennese Waltz Down Wall Street. So let me ask a question about one of the weaknesses that is made, a criticism that is made against those who use Austrian economics to make investment decisions. And it's a general criticism against gold bugs, that they are always so pessimistic that, yes, they're very good at predicting the crashes, but they're very bad at picking stocks when the stock market's booming. They're afraid of getting into the market because they know that it's artificial, it's an artificial boom, and the bust could come at any time. And so they tend to buy gold. They're comfortable buying gold, but they're not comfortable buying stocks. As money managers, starting with Chris, is this something that you have to fight internally?
It is, certainly from a marketing perspective as well with clients. But first let me say, by the way, I just got done reading your book, Mark, which I enjoyed. And I was talking to Harry before this, and he's quoted extensively in the inverted yield curve section, which he had no idea about. So I think you may owe him some money or something in that regard.
Yeah.
But, back to the central question. You're absolutely right. It's funny, being an Austrian, it's difficult to interpret the market's reaction to any given event. So, for instance, the Federal Reserve, Bernanke comes out and says, we're going to slow down. Actually, what he said was, we may start tapering if a couple events happen pretty far down the road. We may ease up a bit. Well, the market obviously plunges. Well, in reality, he's doing something by quantitative easing, which is a negative. So eliminating a negative action should be a positive. The market should be ecstatic about it. So from a short-term perspective, Austrian economics makes it a bit difficult to gauge the market's reaction, although it probably shouldn't, because it's a lot of times doing the exact opposite of common sense. But related to the exact timing of in being a perma-bear, which I think is the term you used in your book, Mark, it is something you have to be aware of. I mean, I have a number of books on my desk from a lot of writers that have been predicting doom and gloom for some time. So I think it's important. You can't exactly time the market. So stocks and bonds, to some degree, have a place in your portfolio, but you have to be very disciplined about it. You have to constantly be rebalancing, cutting back, and minimizing the exposure as much as possible.
Harry, do you deal with the emotions?
Sure.
You're married to gold as a fundamental, sound part of a monetary policy. Do you deal with the doomsday scenario that is often accompanying Austrian economy?
Yes, I think the problem the Austrians have is that they think that everything's going to go to the limiting case. The limiting case, of course, is a complete collapse and whatever else. I'm more optimistic from this standpoint. I do think that there are some dangers. I don't think that every crisis is going to go to the limiting case of a complete meltdown or the German where they're printing up the money. I know that there are a lot of problems, but you can't. One of the things of Austrian economics is you can't time this thing. You don't know. I have a large part in my book talking about the impossibility of using mathematical models in doing this. So what I've done is I've not invested on the doom and gloom strategy, that there's all of a sudden going to be this hyperinflation. It will take time for this thing to occur. It's not going to be, like one day we're going to wake up and money is going to be pouring down streets. There'll be a certain gradual time, and you'll get to this J curve when it does take off. And I do agree that the limiting case is a catastrophe. But we don't know when that catastrophe is going to happen. And I think if you invest, and the mistakes I've made in investment have been assuming the catastrophe where I've made the mistakes is going to happen tomorrow, where I think it's going to take some time for this to wind down. Let's say that we do have this problem. The American economy is a very strong economy because of the people that make it up. The division of labor is going to be there. The machinery is going to be there, okay? What's going to happen is there's going to be some financial glitches, but the economy, I think, will revive. I think the more serious thing I look at is the birth rate. We have to have 2.1 to survive. We're at 0.74. We're one-third of the way. So in the long term, I see demographics as much more of a factor than the others. I think the problem is we Austrians preach doom and gloom all the time. Because remember, there's an upside to the cycle, too, and you can invest to make money on the upside. And so the yield curve kind of helps you to say, well, I got something in my pocket that in case it looks like it's going the other way, this yield curve might work.
So, Ty Andros, the money supply, the quantitative easing, the super low interest rates, the Fed has been pumping money into the system. As Jim Rogers said to us, every major central bank is engaged in a persistent inflationary policy, and yet gold, your favorite investment, has lost 40% of its value in the last 2 years. How do you explain this phenomenon from Austrian economics?
I'm going to say that there's no asset class out there that we know what the true price is, because we don't know what this is worth. We have no idea because it is completely unidentified. It is just an illusion, and it's an illusion that's going to come apart in an ugly manner. And I couldn't disagree more with Harry. I believe that actually they've removed the ability for this economy to survive and recover. If you actually really take apart the economy since 2008 when the crisis happened, and you really go into the cover, it's gone like this. If you look at stock prices and subtract the amount of credit the Federal Reserve has printed, stock prices have gone like this. Between 1950 and 1980, the economy grew by 125%, and debt grew by 12%. That's real wealth creation. Between 1980 and today, the economy's grown by 125%, but credit's grown by 135%. Is that real wealth, or is that debt masquerading as wealth? Do you think that money's ever going to get paid back? I would beg to differ. And Austrian economics has the road to salvation and preserving and building your wealth. But you have to learn the indirect exchange. You have to understand that at some time we're going to have a unit of money that actually tells us what the price of the assets are. And until we get to that point, this chaos isn't over. But it's, it sounds like doom and gloom.
Sounds like doom and gloom to me.
But it is not. It is the greatest opportunity in history. But you have to set your sails correctly while these things are going to happen. And can you say what stocks are going to do next week or next month? Anybody that tells you they can tell you that short term is a fool. Okay? You can't tell. But you can tell where we're going to go over a 5 or 10 or 15-year period. And that's what I meant when Austrian economics are extremely predictable.
I think 5 to 10 year experience isn't good enough for most investors. I mean, Steve or Adrian or both of you, comment on this. You're dealing with investors, your customers, how patient are they? Are they willing to let you struggle for 5 years not making any money while you wait for this scenario to play out?
Well,
or do you have to be more short term?
I do my best to teach them what to expect. And here's the way I look at an investment. Gold is an asset. Gold is not an investment. Gold's a store of value. It's not really money because it's not used as a medium exchange. It is a measure of value. But I let them know it's not an investment. An investment, properly speaking, the way I look at it, is something what Benjamin Graham or, believe it or not, John Maynard Keynes would look at as something that creates cash flow. So the portfolios I build are centered on dividends, royalties, rents, income. I need to have income. I need to have cash flow. And that to me is an investment. When you look at anything else out of that, when you're trying to gauge what's coming into you, if you're looking at something appreciating, you're looking at a price increase, what you're doing, you're speculating. And I'm not denigrating speculation, but that's what you're doing. You're letting somebody else, market participants, hopefully come over to your side and then drive the price of an asset up because your long-term scenario is right. As an investment, I look right now in what we've got. And most of the people I deal with, they understand that. They understand we can go periods without either flat or low and to expect that. And I don't get too much flack about it. But I think some people got in trouble with gold here, not understanding maybe how the market works, how it's not this. You'll hear people say, well, the gold supply. Well, the gold, what comes to market really doesn't matter. The gold market really trades like the stock market does. You have to have a marginal investor come in. And one thing I pay attention to, real interest rates, and Austrians are right on this when it comes. I think people confuse CPI as being the inflation rate with the growth in money supply. The credit spreads, yield curve is another something else you look at. But something else, and this to me would fit in perfectly with Austrian philosophy, is eyeball the joint. Look what people are doing. I pay attention to media. The kid standing on the street corner twirling the sign, "We buy gold," shows.
Fox News advertising.
Yeah, all the advertising. The shows on cable TV with a bunch of knuckleheads go to Alaska or go down to Brazil or go into the Bering Sea and are trying to, soak up gold. What this reminds me of is, if we go back in history, comparing the Portuguese to the Spaniards. Spaniards were focused on gold, especially back in the 18th century. The Dutch were interested in taking raw materials, moving them up the ladder, adding value along the way. And yeah, they may have had all the money, but relatively speaking, the Spanish were a lot poorer than the Dutch. The business of money has always been a bad business. Manufacturing it, getting it, mining. I've never liked the business of doing it. And look, I'm a hard currency guy. I'd love for us to have a gold standard. But you really need to be careful. If you're speculating in it's one thing. If you really are looking at it as part of your portfolio, there's a fellow named Paul Van Eden. He's got an excellent long-term graph that goes back to 1971 when we officially abandoned the gold standard. And what he monitors, he takes a look at money growth, and he does it with coin currency, short and long, small and big-time deposits, and the growth and supply of gold. And he's overlaid it, and it doesn't match up perfectly, but you go through a period of long, theoretical prices is below what the real price is, and then vice versa. And right now, the real price is way above the way he's got it with the theoretical prices. I mean, he's got the theoretical price at around, based on the increase in money supply in gold stock, at around $1,000 an ounce. Yeah. So he overlays that. And by the way, the Austrians do a very good job. There was an excellent article, and I wish I could remember the guy's name, in the Journal of Austrian Economics, explaining the difference when it comes to inflation with the Treasury Department issuing currency directly and doing it through central banks. And there is a difference. People will point to Weimar Republic, Germany, and to Zimbabwe. But that was mostly a direct treasury injection of money compared to a central bank. And it doesn't tend to be quite as inflationary when it filters through the central bank. And I'm not saying it's a good thing what we're doing.
Through the banking system.
Yeah, so something else to consider.
So, Adrian, do you ever put gold in your portfolio, pure gold, or are you, because I know you specialize in foreign stocks and mining stocks and maybe other things. Tell us, what is your strategy using Austrian economics to make these kinds of decisions, and how do you deal with these biases that the Austrians face?
Yeah, that's a good question. When you asked if I ever put gold in my portfolios, I thought you were being facetious for a second. But you said it with a straight face.
Yeah, I thought maybe you buy
Sure.
an ETF like GLD or something like that.
We do indeed put gold in portfolios. I mean, gold to me...
You have it in there now?
Yeah. We've been buying
So you've been losing money.
We've been buying the last month. Well, we've been losing money over, what period of time compared with what period of time, If you look at gold over 10 years, this is the first year that gold's going to have a year-on-year decline. The year's not over yet, but the year's not over yet. But if it stays where it is, it'll be the first year in 10 that we've had a year-on-year decline. It's not true of stocks, U.S. or foreign or any other asset.
Gold was down in 2012 and 2013. Both of them.
No, not year-on-year, not average. I mean, you're looking...
I think it topped out in November of 2011.
You're both correct. You're talking about the peak. Absolutely true.
Right. You're talking about average.
September the 2nd, 2011. But from the point of view of average price, year on year, it hasn't had a decline yet. But gold, to me, in a portfolio can be a lot of things. Gold can certainly be a long-term, not even a long-term, almost a permanent foundation to a portfolio. And in that case, you have to have gold itself. You don't want some mining stock as a foundation of a portfolio. But gold can also be a speculation. And if it's a speculation, we would tend more towards the mining companies than gold itself. So, gosh, there are a lot of things people have said. It's difficult to... I think one of the issues, to get back to your original question that you kind of came back to, one of the things about Austrians typically, I like to think that Austrians tend to be more intelligent than Keynesians and other people. And so we can see problems, and we can see underlying problems ahead of a lot of other people. And I think you know where I'm going with this. So just because something is inevitable, as Doug Casey likes to say, doesn't make it imminent. It can be inevitable, but not imminent. And so as Austrians, we tend to see these problems. We tend to see these problems ahead of everybody else. And perhaps, arguably, we overreact on the basis of timing, because it may be a long time before it comes. I think the other thing I'd say is also, I don't know if you agree with this, Mark, because obviously you know more about it than I do, but it strikes me that with Austrian economics, there is often a sort of tinge, there's a moral tinge. I think maybe that comes from von Mises, I don't know, but there's a moral tinge. But because we're spending so much money and living above our means, by golly, we ought to pay for it. I think there's that as well. And so that can have that sort of bias that, my gosh, the United States ought to crash and burn because it's doing everything wrong. And I'm exaggerating a little bit, of course. But, think of Bill Barnard, the very title of his newsletter, The Daily Reckoning. It's a reckoning,
Yeah.
I mean, that tells you a lot. A Keynesian wouldn't call a letter the reckoning.
And he wrote that first book on reckoning, The Day of Reckoning, back in 1990.
It sounds almost biblical, doesn't it?
But by the way, I have with me, not with me, but in my home, I have this shelf of library books about doomsday books, Howard Ruff, Doug Casey, and so forth, Crisis Investing, How to Prosper During the Coming Bad Years, which was written in 1980 when Ronald Reagan was elected. Well, not written. It was actually published in 1980. So sometimes timing can be off there. We have 10 minutes. If you have questions, come on over here to this microphone to ask questions, and we'll take your question. I would like to ask, starting at the end, put on your thinking cap. What are you doing right now? Can you give us a recommendation that from an Austrian perspective, hey, this is a good time to be invested in X?
Well, I'm not going to mention gold, although I certainly do think gold and silver and actually maybe a little bit more so silver right now, is a good place to be. Let me first give you my perspective on what's happening. The money supply since '08 has just obviously exploded. I mean, depending on how you measure it, it's a minimum of a third, maximum about 260%. That's from August of '08 through, I think, April of this year. So anything that is protection against inflation is great. Well, real estate fits in that category as well. However, if you're expecting an inflationary recession like we are, think 1970s on steroids, a lot of real estate is going to be a horrible investment. But I do think, to answer your question, Mark, I do think agricultural farmland, besides gold, is a great place to be right now. It's one of those investments, despite its current or recent run-up in prices, I think it's a great place to be. One of those investments where you can put some money in and sit back and relax and look at it from 5 years from now, and you're going to be quite pleased. Now, it's not easy to invest in farmland. There's not a lot of great vehicles out there, but there are a few, and I think that's a great place to be.
So you could invest maybe even timber stock. There's a number. Is that what you're talking about or not? More just basic land.
Yeah, I haven't looked at the timber too closely, but I would guess that maybe that's more closely related to the economy than foodstuffs are.
Yeah.
So.
Okay, Harry, how about you?
Yeah, every time I go on vacation, I get into cash because I want to relax.
You like cash?
I like cash. The reason I think that the yield curve is so steep at this point is I think the markets are being driven by fear, and people are afraid to go into the bond market because they don't know what these interest rates are going to do. And ultimately, the interest rates are going to have to go up.
But, Harry, they're coming out of the bond market, long-term bond market now. That's why interest rates are spiking, right?
Yeah. And so what I think is that the reason that they're holding it is because they're worried about, and I'm worried about, the deterioration of principal. In other words, if these interest rates go up and you're in bonds, now I have in my portfolio flexible bonds so that they'll rise and fall with the interest rate, so it protects the principal. And right now I'm in principal protecting mode at my age.
You're in you said cash position?
I was in stocks, and I said, I kind of want to relax over my vacation, so let's get out of stocks right now. And I told my broker, Dave Bruhan, I said, in October, we're going to look about going back in because then I'll be able to relax.
We have some great little quotes in the Maxims of Wall Street, and one of them is, in cash, it's both good and bad.
It's
good because you can't lose money, but it's bad because you can't make money.
Yeah, it's just a short-term play at this point, Mark.
Yeah.
It's a short-term play.
Yeah.
Gold, I made some money. I got out of it some years ago because there's a difference between a gold standard and gold investments. And to me, when you have something that the marginal cost of production, depending on the mine, is $600 to $800, maybe up to $1,200 an ounce, and it's selling for $1,700, to me that was a little bit too risky. Anytime you're selling something for 2 or 3 times, in some cases, it's marginal cost of production, probably an idea that there's too much fear in this market, there's too much emotions in the market, and I said I'd rather not play on emotions.
Yeah. Steve?
I wanted to ask here real fast, when you say cash, do you mean American dollars, or how are you holding that?
Well, the dollars are going up in value, so I'm
holding it.
The dollar
is actually strengthening lately.
Not much. The dollar is strengthening, so I'm holding it in American dollars. And the reason the American dollars is, in my opinion, going up is because everybody else is so bad. We look good.
Yeah. All right, we don't have much time, so Steve.
Okay, I'll make it quick. I like to quote this great Austrian philosopher, Ringo Starr. Everything government touches turns to crap, so you got to keep abreast of their scatological hands. And right now, what I'm saying is what they're attacking. And right now, I'm looking hard and long, eyeballing, if you will, coal. The coal industry, coal
you
stocks,
think gold looks good right now?
Coal.
Oh, coal. I'm sorry, coal.
Coal. So
right.
Yeah.
So coal and coal stocks, right? Yeah. Huh.
Well, yeah. For me, one investment, again influenced by Austrian, would definitely be gold. When you look at what the Federal Reserve and other central banks around the world have been doing for the last several years, and when you look rationally at whether they are likely to fundamentally change direction anytime soon, I think you have to answer no. And as we've discussed and other people have discussed at other sessions here, I mean, the market's reaction, particularly the gold market's reaction to the Fed and Bernanke's sort of tapering comments was just grossly overdone. I mean, all they were talking about is possibly cutting back on the additional stimulus that came in January, sometime later this year, if the economy continues to do well. That's an awful lot of qualifications. And again, I remind you, they're cutting back on the additional stimulus. It's a bit like when Obama proposes a budget with 5% increase in spending, and Congress cuts it back to 4% increase and says we've cut the budget. They haven't cut a darn thing. We haven't, and the Fed is not talking about shrinking the budget, the balance sheet. They're not talking about shrinking the balance sheet. They're only talking about cutting back on the increase. So gold.
Okay. Are you going to create a little...
I'm going to drop a bomb.
Oh, okay.
Okay. First of all, I'm going to say, just give a quick thing. You wanted a prediction. I'm going to say that gold right now is the stock market in March of 2009. And it is at a very rare juncture that can be looked at over a 40-year period. If you really actually look underneath the covers of the gold market, there's been a run on the bullion banks going on for over 6 months. Where has that gold been rotating to? I'm going to tell you where it's been rotating to. Into the strongest hands in the world and central banks. You can never store wealth in paper again. They are going to print it endlessly as the waves of insolvency strike our economy. Our economy in real terms is collapsing. You may see a nominal print that shows the economy's growing, but it is not. And I'm going to interject right here. This is still the greatest opportunity in the world. But you have to learn how to weave what's called the indirect exchange into your portfolio so that you can reprice to reflect as we transition from the monetary system we have now to the one that we're going to go to. You also have to be able to put absolute return investments into your portfolio that can make money as these malinvestments go to their true price, which, like I said, is unknowable at this time.
You use the term malinvestment, which is very important. It's the first time we've used this here, and as Harry knows, all of you know, if you've studied Austrian economics, malinvestment rather than underinvesting, which is what perhaps the Keynesians or the monetarists would use.
My breakout sessions real quick.
Well, you have 1 minute to do so, because then we have...
I've got 2 breakout sessions. One at 4 o'clock today, which is about something for nothing societies and how they actually signal the end of every empire in history. When we talk about what's going on right now, that is nothing new. This is history repeating. But this is history repeating on a scale never before seen. We've never seen a sea of fiat currencies with really no regular currencies out there. When you talk about gold, the idea that gold over a period of time is going to go down against something that's conjured out of thin air and printed endlessly is a fiction. But we'll see. Then tomorrow, you have to understand when Austrian economics...
10 seconds.
Part is human behavior. The other part is the excesses that have to be unwound. And I'm doing one on fingers of instability tomorrow, which will show you how you have to position yourself or parts of your portfolio to benefit as these things unfold, because we don't know the time frame. It's just going to happen.
I'm of the opinion that we're in phase 2 of this business cycle, this investment cycle, if you will. Phase 1 is where you had extremely low interest rates. There were crises from time to time. People would jump into treasuries. The rates across the board fell, but you still had a positive yield curve. So both stocks and bonds were rallying while, and so were all other assets. And then gold was the first one to fall apart and top out. In my opinion, gold has topped out for now. I don't know for how long, but I think it has topped out, and And I actually gave a sell signal in my newsletter back in November of 2011. I think a lot of it was luck, just kind of sensing it had gone too far too fast, and it's come down. Now, I do not have a very strong gold position right now. In fact, I've sold out of a lot of our positions. I think phase 2 is this great separation between stocks and bonds. So bonds are now, I would be completely out of bonds, and we've minimized our position in bonds. And we're moving now into dividend-paying stocks, and particularly regional banks, because regional banks that offer mortgages at these very high rates right now, they're going to earn a lot of money. So their net investment income is going to rise rather spectacularly. So I have some specific recommendations on regional banks that are benefiting. So that's just my strategy right now. Why don't we thank our panel? I want to thank them. We had a great panel of Ty and Adrian and Steve and Harry and Chris. Thank you very much. And this is the beginning of a panel that I would like to see repeated. So thank you all very much, and we will see you at the next session.